Brian Levy, for those of you who don't know, along with Ken Milani and Jessica McManus, we have responsibility for Ethics Week. So we've got our fourth Ethics Week speaker here, batting cleanup, Tim Hart. Full disclosure, Tim is a friend and a classmate from the class of 1984. A long time ago. Almost, we're old, Tim. We are really old. But the good news for you is, not that we're old, the good news is that Tim has literally been flying around the country and around the globe for almost 3 decades, investigating a who's who of corporate scandals, a rogues gallery of deals gone bad, internal investigations, forensic accounting, expert witness. So with that, I'm going to turn it over to Tim and let him tell you about those 30 years of experience. Please join me in welcoming Tim Hart.
Well, certainly, thanks, Brian. Thanks, everybody, for coming out today to listen. I mean, when Brian called and asked me to come here, I said, well, February in South Bend, thanks a lot for the invitation. But then when he asked about the topic that he wanted me to speak about, I said, well, I've actually been doing things that are interesting, and ideally there's some lessons that will come out of this that I can share. And as we go today, feel free to jump in, ask questions. I get cross-examined for a living, so questions from the floor live are fine by me, so please don't hesitate when you have questions or comments. Just as background again, kind of why listen to me? Been at this for almost 30 years, an accounting major from '84, left here and joined Arthur Andersen to do audit work. Back in the days before there were specialties in the accounting world, you kind of were a tax person, or maybe a system consulting person. I fortunately found my way into forensic accounting inside of Arthur Andersen. It was there until Andersen ended with Enron back 10 years ago. And I then spent time leading the practice at Navigant Consulting and then Huron in the disputes and investigations world. And when Huron exited the business, the disputes and investigations business in 2010, I set up my own firm. So I've been on my own from the biggest global type firms down to a small firm that is based in Washington, D.C. My practice has spanned disputes, investigations, and insolvency, primarily in the insurance world, and that's where a number of our stories will come from today. I first want to say the financial service industry, I think of all the industries I practice in, is more of an ethical proving ground, and we'll talk about that. I don't bring you academic models. I bring you things I see in the field and turn to kind of my own way I think about the practical ethical continuum, and we'll talk about that in the case studies. And then when we're finished, kind of talk about my observations on the root causes and the commonalities between the troubled situations that I've had firsthand front row seats to. In terms of financial services, the customer usually gives cash and gets a promise. I mean, it's kind of that business that's got a lot of risk. You turn it over and say, here's my money, and hopefully you're going to deliver me benefits in the future. I'm going to show up and want my money back at my check, at my bank. I'm going to want you to provide the insurance benefits. So it's a place that has attracted sketchy characters for a long, long period of time. The products themselves can be unsuitable for customers, whether you're talking about a particular mortgage or an insurance policy, good examples. They also can be unsuitable for those who are holding them as investments. So a particular institutional investor may hold investments that are not proper for them. When you think about a financial services firm, fundamental to it is to earn interest rate spread over a period of time or some other investment income that is greater than the money they received in order to pay back the benefit or the promise. Some industries you can say, if you depend on where you are on the political spectrum, some say everything should be regulated, some say unregulated. I can't see a place where financial services should not be regulated because of that risk to the consumer that they're going to give them the cash and they come back for the promise and it's no longer there. Oh, quick finger. There we go, sorry. Okay, if we think about the financial service industry, there's a history of crisis, stock market crashes, savings and loan crisis in the 80s and the early 90s, insurance insolvencies in the 1990s, the Asian financial crisis, the recent global financial crisis, just to kind of name a few. When we think about these crises, they're often the time when the excess comes out, the wrongdoings that created a bubble are exposed when the market goes down and you don't have increasing earnings in the next period to cover maybe the inappropriate accounting. The mortgages stop performing. So the sales practices that were likely unethical in terms of either the end consumer being put into a mortgage that you knew they couldn't afford, or flip side, you originated a mortgage and turned around and sold it to somebody else knowing the underlying credit was not as good as it should have been. All those involve ethical decisions that people make. Insurance insolvencies, we were going to walk through some case studies firsthand of ethical things that people did or did not do, causing trouble. And then the global financial crisis, we'll talk about this more specifically because it's more recent and people really have been studying it. And you think about the ethics involved there. The inappropriate products were sold. There's just no question about it. People who are veteran in the mortgage business knew it was wrong to sell subprime mortgages. You were causing people to say, I'm going to sign on this piece of paper, and by all probability, I know a good number of you are going to lose that house. It's going to get foreclosed upon. It may cause you personal bankruptcy. It's going to cause you a problem. And people sold it on the front end, and then in turn said, okay, well, but we got this magic now called asset-backed securities. We can now take this risk, bundle it together in a different way, and sell it off to third parties, and magically it will not be as risky. Well, it doesn't make sense from kind of basic risk analysis, but you may be kind of sucked into that, but you need to think each person in that bucket, whether on the originating side, there are people in the group, in the company that had to have thought this is wrong, this can't work, and didn't raise their hand enough and try to stop the sales practice. Flip side, people who understand risk, because it went to Wall Street doesn't mean the risk went away. It just got uncoupled from the organization that originated the risk. In the old world, the bank would have made the loan, held the loan, and suffered the consequence when it went bad. Now they say, well, it's in the security, it's off there, it's off our balance sheet. We don't have to worry about it. Next, disclosures and valuations were wrong. When you think about the securities themselves, or you think about the pool of mortgages as they get sold, that the people bundle them up trying to say, hey, I just got these people to sign these pieces of paper. I gave them money. I want you to reimburse me for the money I gave them. I want to sell it to you. Even though the risks were already starting to emerge as the crisis came on, they kept selling them with below par disclosure. So people in that group had trouble, but also the people valuing the securities. As they said, all right, well, I'm trying to tell people that these are worth what they're worth. You need to think about, okay, well, I'm starting to see emerging basically defaults, other signs that tell you they're not worth what they were worth yesterday, because I'm seeing real world things happen. And people didn't step forward and say, hey, stop this. They kept selling more of it because you need to beat last quarter's numbers. As I said, the sales being uncoupled from the holding of risk. The insurance industry had troubles in the 90s and before, because they were the first to really say, let's take insurance that I write to somebody, rather than holding it and taking the consequence myself. They rapidly reinsured that out around the world. The global financial crisis to me was the banking business turned around and did the same thing. Let's take my loans and spread those around the world. And then many of the players were involved. And then last, the compensation systems rewarded the short term. The originator who wrote the mortgage got paid their commission, sold it, it went away. There was no participation in the long-term profitability of the pool of mortgage from the people who actually put it together. And then the people who then securitized it and sold it to the market, they got their fee and sold it on, and there was nothing that came back to them in their compensation over a longer duration to see how this newfangled thing actually worked. One thing I like is the Freddie Mac, you can't read it very well, we make home possible. Okay? In my world, if you're going to sell somebody something that's the most important thing on their balance sheet, their house, it should probably be probable at least, or highly probable, not just possible. So let's sell people possible. That's, to me, a very bad kind of model in terms of saying, come, sign this piece of paper, the biggest piece of paper you're going to sign in your life for most people, but it's just possible. I kind of thought it was funny. Okay, in terms of the players, I've kind of chatted through a number of these people: originators, investment banks, regulators, Congress, Fannie Mae, rating agencies, and institutional investors. What I think about in each of these groups, I mean, the people here in this room can end up in any of those roles or influencing any of those roles. And as I think, a good example is Fannie and Freddie. Forever, most all of the mortgages originated in the United States somehow touch Fannie and Freddie. And they've been doing what they did for a long period of time. Congress is saying you need to do more of it. You need to have more people with lower income owning homes. And so the risk managers trained who've been in the mortgage industry for a long period of time in Fannie and Freddie, raising the flag saying, hey, this isn't going to work. We're not going to know tomorrow, but there were whistleblowers inside that this is not going to work, but it didn't stop the train. In each one of these organizations, I would say, as you're seeing red flags on things that don't make common sense to you, that's when the questions need to bubble up of you saying, well, should I be raising my hand? Should I be talking to my boss? Should I be doing something to stop a practice you think just doesn't make sense? Again, this is not an academic model, but as the saying has been in movies and has been lyrics in songs, you can steal more of a briefcase than you can with a gun, that you're going to go out into organizations that have control of capital. I mean, lots of capital. And you're going to go out and say, okay, if you're in financial services, you typically are selling to consumers or you're selling to businesses in large volumes of products that may or may not work. Agreements you may or may not be able to fulfill 10 years from now, whatever duration it is. And if you're doing things that are not, you think, on the up and up or on the edge and you're not sure they're right or wrong, the impact's going to be pretty high. I'm not typically called in when people are kind of up at the angel end where it's all clear, it's all beautiful, there's not a tough question. And we're not talking about kind of robbing the bank. It's like people seem to know on both ends of the scale, okay, well, this actually sounds criminal on one end versus there's not even a question. It's that middle portion of the scale that you're making the judgments day by day. You're auditing a company, you're in your first year auditing, or you're trying to make that tough decision about whether the client is valuing something properly. You don't agree with their valuation model. Are you going to ask the hard questions or not? To me, that's the practical world of each day in business. You're confronted with things that you got to make judgment calls. Are they right or wrong? Now, got to pause for a briefing from our sponsor here before I get into the case study. When an unethical trading scheme based on your parents' house isn't working, you get frustrated. When you get frustrated, you hatch a scheme to loot insurance companies. When you loot the insurance companies, you buy a big mansion in Connecticut. When the authorities look for you in your mansion, they find you've skipped the country in a private jet with women you met on the internet. When you skip the country and hide out in a luxury hotel, you get caught. When you get caught, you end up in a yellow jumpsuit in prison. Don't end up in a yellow jumpsuit in prison. It sounds like an absurd story, but this is true. It's actually more ridiculous, and we'll talk about it in more detail of what went on. I mean, a very bad man behind all this. But what I want to really focus more on are the people who were involved that at different points in time could have stopped this absurd outcome. And so we're going to flash back to the late 90s. this all came to a head in 1999. A character by the name of Martin Frankel, who was best described a loser who had previously been banished by the SEC and not allowed to trade, had to use aliases to con the Catholic Church to get himself started with his scam to buy his insurance companies. So he sets out with his aliases and his different friends in crime and gets people in the Vatican to vouch for him that this St. Francis of Assisi Foundation was going to buy insurance companies and help the poor. So who wasn't going to want to do business with a guy like that? I mean, he's going to do this for the poor. The problem is none of it was true. He ended up acquiring 7 insurance companies through the South. These insurance companies' business, by and large, was writing pre-need burial insurance. So at the point in time when someone is older and says, you know, my time here is limited, I don't want to burden the family with my funeral, they buy this policy. So it's on the books for a very short period of time, and they give the premium and expect when it's time to get buried, the funeral, that the money's going to be there. He had a different idea. He said, okay, well, I can go in and buy these companies, and through a reinsurance transaction, as soon as I close it, I will send the money offshore, and through help from a number of people, made it look like those were legitimate transactions. So he ended up going through a sequence of acquisitions of these insurance companies to the point where he'd acquired $1.8 billion of insurance companies. And in the end, when all of a sudden, the 7th one he's acquiring, the insurance commissioner in Mississippi starts to think, this doesn't smell right, something's going on here. The authorities come in to look for him and find him, and he has left the country in a private plane with a bag of diamonds and 2 women he met on the internet. So it sounds absurd, and you know, he's a very bad man and he's in jail, but there's people along the way that I think if they stepped back and said, okay, well, does this smell right, could have stopped them. So let's talk about the players. There's Marty in the upper right-hand corner, a dashing man. The insurance regulators. In terms of a role out there for financial service regulator, when you think about allowing somebody to control a financial services company, the background checks, the understanding, is this person real? How do you figure it out? When the first one looked and said, oh great, the Vatican's behind him, would you have wanted something more than a statement that the Vatican is behind a offshore Virgin Islands charity, and you're going to give them the insurance company that has this, then tens of millions of dollars of assets? So then he does that and ends up to the next state with, I now own this insurance company that's an asset of the trust. But the money all left and is sitting in the Swiss bank account. But here's this on paper, and so to do that, you can't do it by yourself. You need help from lawyers and you need help from accountants and other sorts. And you need auditors who are maybe not the sharpest people out there. And again, I sort of say, the lesson here with the auditors was, well, they're a small town Tennessee audit firm. They'd never audited an insurance company before. They said, whoa, this guy, he's a player. Let's take him on as a client. And kind of ethical question 1, should you audit something you don't understand? And 2, if it's in the end a $1.8 billion enterprise among 7 companies, should your audit work papers really fit on a table this size? From my experience, the answer is probably no. The Catholic Church. You go to the Vatican. If you're going to go and use the church, go large, go straight to the Vatican and say, I've got these guys here who vouch for me. They basically vouched for in the beginning and wrote letters saying, yeah, they're the beneficiary of this great St. Francis of Assisi Foundation, and that was the sort of the start. So even if you're doing charitable work or you're in a nonprofit, you've got to be thinking about dealing with unscrupulous people. The company employees. He acquired operating insurance companies, the people that understand when you're running an insurance company, okay, I've got assets and liabilities. Liabilities are what I owe the policyholders. The assets are whatever I'm invested in. Marty comes in and says, I've got this scheme I've got this great trading deal where I can rapidly trade treasuries faster and smarter in the market and make these kind of returns. So he was falsifying statements, but some of us step back and say, how can that be? The spreads aren't, you would pay more in transaction fees by these trades than you could make in the spread, but it's all fictitious. But for the companies, I mean, to me, the people who are on the investment side of the business and the acquired companies, they said, this can't work. But no one did. And then Marty himself, pictured there in yellow, not a good man. But you don't want to be helping those people. Okay, what are lessons? Beware of people who claim to have proprietary investment systems. You know, if they do, understand them. Rapid-fire acquisitions. So as he quickly, over, I think, a 3-year period, acquired 7 insurance companies, it looks good while it's happening, but you don't get enough time to see, are these actually operating with real profit and real cash flow? I mean, not accounting profits, but real cash flow. I mean, in terms of understanding something, where is the new cash coming from? And is it actually your cash? Multiple levels of due diligence failed in this entire scheme. And as a fraud investigator, a fraud examiner, people's personal lives matter in terms of entering into something with someone who would have higher level of risk. The guy who was operating with aliases that you should have been able to figure out in some way, shape, form. He had been living in his parents' house till his mid-30s, trading unsuccessfully. And eventually he's in a giant mansion in Connecticut, owning 7 insurance companies, living with 7 women he met on the internet and other sketchy things. He should have been able to figure it out somehow, kind of red flags. We're going to switch next to Drexel. Back in the late 80s before, let's see, I think most of you were born at least, but when I first got out of school, about 3 years later, I had the experience of working on the investigation of Drexel when it was being investigated by U.S. Attorney Rudy Giuliani, and Michael Milken was the prime player. And I was in Beverly Hills in their high-yield bond operation, and there's Michael, the main player, the junk bond market, Michael working the trading desk, and the book about it, which is a great book. I didn't get pictured in there, but many of the pieces of evidence were near and dear to me. Let's go focus in on the underlying market. I don't think it's disputed that Michael Milken is the father of the junk bond market, you know, the junk bond king. You see, there really was nothing in this. In the junk bonds, now more appropriately named high-yield bonds, helped basically take companies that previously could not get debt and allowed them to bring debt to the market that was higher yield. And Michael's the guy who created the market, and the axis there is billions of dollars. In the 80s, $1 billion was a lot of money. You know, not so much now, but back then the B word was huge. So you look and see the sort of the volume, and he was the market maker, and I'm not going to get the percentage right, but I think of 80% of the offerings in the mid until maybe 88, 89, other people got into it. So he owned this market, huge amount of money. But you notice right here, we had no issuances. The junk bond market crashed. And that'll be important to my later stories, but not as important to this story. But the underlying story with Drexel, let's go through who's who. Michael Milken, head of junk bond trading, Wharton graduate, brilliant guy. 99% of what that guy did for the U.S. economy, in my view, was fantastic. This little bit that he probably got wrong. In 1987, he took home a W-2 form for $550 million. Donald Trump said back then, you could be happy with less than that. So I'll give you an idea of kind of the league he was playing in. Next, 2 famous names from the last time insider trading was in the news before the most recent wave, Ivan Boesky and Martin Siegel. Boesky more of the poster child, and Boesky was your bold-faced, I learned about something, I made a big, bold trade on it and made millions and millions of dollars. I mean, and he was known to have 5 phones, a standing desk. He was supposed to be the player. He knew the market, but he was getting it because he was getting inside information from Milken. Martin Siegel was another guy. The reason I put him up here is smaller time player operating off the same information, but he actually took his profits, in a gym bag to the islands in the Caribbean to launder them. So just lesson there, if you find yourself putting money into a gym bag, you may want to stop. What you're doing is probably not right. Lisa Jones, she was convicted in this. She was convicted for obstructing justice, but Lisa Jones was a runaway from New Jersey who falsified a application to get a teller job in California, eventually falsified her employment application again to get a trading assistant job at Drexel. At this time, she's 24 years old, making $100,000. $100,000 in that point in time was a lot of money. My first job out of Notre Dame was a good job. I made $19,500. So here's a trading assistant taking trade tickets and doing other clerical tasks, making $100,000. And we'll come back to why it's important. The Drexel Management Board of Directors, in terms of, sort of what do they do as this high-yield bond operation was what launched Drexel from being a smallish investment bank to being a powerhouse, was because they created a market in high-yield bonds. So this left coast unit basically ended up destroying the firm. What are the lessons here? Well, first, Michael was a fake back then with the fake rug. He was those earlier pictures you saw. He was as bald as he was in those pictures, and once he was found guilty, he peeled off the toothpaste. That's the real him. But the power, it was, I control the market. He was the market maker. If someone was going to bring a junk bond offering back in the day, it was going to go through Michael, and he controlled it very closely. He controlled which companies were going to get financing and who was going to get to buy these bonds. He had his listing of customers on the other side. That First Executive Life Insurance California got the first phone call. Hey, I got these great new MCI bonds. Do you want them? So he was a very powerful guy, and in the end, I think it corrupted. Excesses cover a lot of problems. When we arrived to investigate Drexel in Beverly Hills in 1987, I mean, the parking garage there was like a car show you couldn't believe. The compensation that people were making off of controlling the junk bond market was amazing. And so they end up with this giant, profitable operation that you don't see some of the excesses that are helping to fuel it. This is, unfortunately, something we've seen either a rogue business unit or a rogue trader basically wiping out a business. Because of the excess practices, Drexel ended up going into bankruptcy after the investigation had been going for a couple of years. This is something else in terms of when you're either running a business, when you're thinking about taking a new position. I've seen over and over again when I find I'm in a company that has got compensation well above the market, up and down the pay scale, that the people don't feel like they have mobility, that they are trapped in the job. They can't go because if someone all of a sudden is making more money, most people naturally upsize their lives to their new paycheck. They think they're worth that. So I've seen when people are paid well above market scale, oftentimes they feel pressured into doing things that aren't right because they can't afford to lose a job. And the other thing, when I've seen either alleged new market or a real new market or a real new product, it takes off and the profitability is huge, you don't see some of the underlying problems because the profits just will blind people. And in turn, the person who's behind all of the profits gets excess power in the organization and become somewhat untouchable. Let's switch over. Let's move in the time machine forward. If you remember when I said, okay, the junk bond market grew, and crashed in 1991, we will enter guarantee security. The Florida life insurance that failed from rapid growth, looting by management, risky investments, and also just straight fraud intended to hide the risks, the regulator. There are above market commissions paid to agents, and this is just something to think about. When you're originating business, whether it's financial services, I mean, really much more in consumer businesses, if you have to pay a lot to acquire it, you then have to understand you have got to make above average returns to pay for that commission, because it tends to come out day one. You say, I just sold something and I paid somebody 10% up front. You need to make up that deficit if you're paying above market. So I've seen that as a warning for whenever people are paying a lot to acquire the business, the odds of trouble later, and for the kind of the ethics side, when you see that, you want to question the model. Can this work? Is this projection going to work over a long period of time? And here, I mean, this one was so clearly aided and abetted by employees, investment banks, lawyers, and auditors that all got caught up in this growing company. As further backdrop with this company, this guy, Mark Sanford and William Blackburn, were guys who were just stockbrokers in Kentucky in '84, read a book about the insurance industry, and it told them, it said, look, most insurance companies, they give you the money, and you don't need to give it back for 30 years. And Sanford says, that sounds like a great business. I can do a lot of things with money over a 30-year period of time. So they moved to Florida and bought a tiny little insurance company called Guaranty Security. Merrill Lynch, the investment bank that was involved in a number of the transactions. Sharif Friedman, they've morphed into 3 other firms since then, were the lawyers. And Coopers and Lybrand were the auditors of the company. The one who got off the least was Blackburn, because he ended up retiring before most of the bad stuff happened. But everyone else paid substantial penalties, was investigated by federal agents, and all the sort of things you don't want on your resume. The lessons: complex intercompany transactions. We've got to be looked at and say, okay, why are we doing this? What's the purpose? And when I'm done with it, do the financial statements fairly reflect the underlying company? And on a consolidated basis, if you do an intercompany transaction, and somehow there's more enterprise value when you're done, you need to think long and hard about whether what you just did is right, because that would tell you that the money, some value is created out of a non-arm's length transaction. The other thing is I've seen, when you think about the real world, okay, here's your GAAP financial statement. It says here's how you need to account for something. Financial services, you have your statutory statements, which says, okay, here's how the bank regulator wants to see them. Here's how the insurance regulator wants to see them. There's different rules about how you account in each circumstance. On the statutory side, that's really what drives an insurance company. You say, this is what tells me my regulator is going to let me operate with a certain amount of capital, depending on how risky it is. And I've seen too often where people say, okay, if I structure this, they restructure something I already own in a different way, I can get different risk treatment on the asset, therefore needing less capital. So when you see somebody looking to say, I'm trying to restructure my balance sheet, there's no real change other than you've changed the paper, and all of a sudden a risk ratio changes, it's a pretty ripe area for trouble. Odd business models are often a warning. In this instance, the reason I tie it back to 1991, Fred Carr, who ran Executive Life of California, was considered to be one of the more savvy buyers of the junk bonds, and Executive Life of California had those bonds on their balance sheet. Mark Sanford was sort of the bottom of the call list, so when he couldn't sell to somebody else, he sold it to Sanford. So I investigated Drexel, and I knew what the good offered bonds were. I saw their balance sheet a couple of years later when we were doing the work for the guarantee system to see how deep is the hole. I was like, whoa, these are the worst, sort of the worst issuances that Drexel put out. So he was the last guy that got the phone call when he couldn't sell to anybody else. But he was saying, look, these junk bonds are going to work, but they're an inappropriate investment in large quantities for an insurance company because they're not as predictable. He also bought direct equity investments in operating companies that were illiquid and basically looting the company through management contact. And here, the unethical and immoral person is a bad idea working for one. I mean, just, you meet somebody, you get a bad feeling about them, and that feeling does not go away. Try not to do business with them, and certainly don't work with them. I mean, all the red flags of this guy should have been there where, it was the excess compensation, the big lifestyle, the private jet to fly to strip joints, during the week with the sales agents, taking $15 million out into strip joints he wanted to directly invest in them. And people who are still working for him, this was all known, and people kept working there. I mean, when you find people like that, you want to not do business with them or, sort of not be employed by them. And then last, beware of a man with a parrot on his shoulder. He looted $7 million from the company to buy his own private island in the Caribbean, an island called Rudder Cut Cay, and he had gold coins minted that said Rudder Cut Cay, 1 troy ounce, with a picture of him with the parrot on his shoulder, and his bikini-clad girlfriend on the back. Again, should be red flags to people that this may not be valuable. Okay, now we're going to switch to Enron, and I think most people will say, well, that's not a financial services company. In the end, it was. I mean, it was previously a sleepy pipeline company, and as it progressed till its death, it became a trading operation and a quasi-investment bank. And I'd also say unregulated in terms of, in the insurance world, in the banking world, you got regulation. These guys are running out there doing financial services without real regulation. In the final years, its financial performance was not coming from collecting money from their customers, making a margin. It was by increasingly making trades with related parties. So you'd say, I own a power plant in South America. Well, let me bundle that up into a couple of securities, sell it to what turned out to be a related party controlled by the CFO, and voila, you would have accounting profits. The problem was there was very little cash being generated by any of these transactions because you're trading with yourself. The other thing, again, whenever someone tells you they got a new business model, be skeptical in terms of internet boom. Oh, you don't need to have cash flow. It's all about eyeballs. Like, what? How am I going to take an eyeball to the bank? Things like that. And Enron said, we're going to be the world leader in trading broadband. What's that? I mean, they told the people at the time that a proven broadband model that could deliver TV to the house or broadband. It sounded pretty crazy 10 years ago. It's now happened. But their model was from a server in the basement of a building in Portland, it showed that it could service 10 TVs in the building. It hardly tells you can send it across the country. And someone as junior as a first-year person out of undergrad might have been running that model, that valuation model, and saying, okay, well, shouldn't we ask a question here and say, is this really something that is a $1.5 billion business? So I think the business model itself, when someone tells you that, you better really study it and believe it yourself, other than just that the smart.
Maybe for the student's benefit, and you can't see it that well, trace the stock price there. Just
yes.
That'd be interesting, I think.
Yeah, let me get my years straight. So we're in January 2001. It's at $80 a share. And this was the management team was highly compensated by stock options and stock they owned. And also, the triggers for the bad things to happen in terms of these special purpose entities where they move the assets off for things to come back to you were triggered by drops in stock price. So as it started down the skid, as the analysts in the markets finally started to figure out this may not be true, it caused massive drop that caused basically a number of the transactions to unwind. So it went from $80 a share to it was at 30 in October of 2001 until bankruptcy declared the 4th of December 2004. So for the players, management, Lay, rest his soul after he got convicted, he died of a heart attack. Jeff Skilling, federal prison. Fastow is not quite out, I don't think yet, but Andrew Fastow was the CFO. Both he and his wife were convicted, and a number of more junior Enron people were convicted. People that were literally a couple, 3 years out of school involved in some of this activity. Investment banks were both helping finance Enron, and also when Fastow called him and said, I got this other special thing over here on the side, I need some money for that to be buying and selling these assets with myself, they jumped right in. The rating agencies, this one, I mean, it was the poster child for, you really dropped the rating the day before bankruptcy? Who did that help? I mean, so again, being careful in terms of your reliance upon some of the ratings out there, that they're not real time, or I don't find them to be. Investment analysts, a number of them were in fact questioning, and there were some really ugly earnings calls where they question and they get shouted down by Enron management. If you're an investor and you hear that kind of thing and management doesn't really want to engage with the analyst and can't answer the questions well, it is time to run. If you're inside the company and you hear that, it's time to start thinking about the transactions themselves. The auditors were Arthur Andersen, out of business from it. I mean, ended up being, in the end, I had a front row seat in Houston for the criminal trial when Andersen, my company, was charged with obstruction of justice for shredding documents. It got reversed after the company was gone, but that's probably should have been more alert as the smoke started happening around Enron, around the risk management of just the way you're handling yourself is really what killed Andersen with the Enron situation. The lawyers, they had lawyers that were helping them with all these complicated transactions. In the end, when someone hires you to do a transaction, you step back and say, well, did any money really change hands here? Who are these parties? Was a real value created? But when you do a sequence of transactions over a number of years that are so complicated that they gave me a headache. I'm not a headache kind of a guy, but I was doing the Enron investigation internally at Andersen. I'm going, okay, who did what to whom and why? And you had the whiteboard going and you're like trying to understand it. If it gets that complicated again, you better roll up the sleeves and try to understand it. What are the lessons? Related party transactions can be and often are trouble. Manipulation of the balance sheet to hide risk, contingencies to add risk. My own experiences, look at the balance sheet, the cash flow statement to understand the company. Is it generating cash? How good are the assets? And how easy is it to understand both of those two statements? Boys club culture, serious risks. It ends up being a bully culture. You can't say no to the boss. Tone from the top and culture are huge risks in terms of accounting fraud, or also just basically bad market behavior in terms of sales practices. And I think it's particularly difficult for people coming into companies at more junior levels that they become influenced by that culture rapidly. It's striking to see as you go from company to company. I've spoken to professional advisors. As a professional, I mean, you got to understand where you stand in a transaction. Conflicts of interest matter, whether they're appearances or not. Clearly conflicted parties in terms of where the money came from in these transactions. It seems too good to be true. It just might be. Just kind of a simple lesson. If you can't understand it, there's a financial statement this thick and you don't understand a piece of it, it may not be true. And it's too complicated for you to understand. I know what the standards are to get in here now, a lot higher than when Brian and I got in. I don't believe any of this stuff is going to be too complicated for the people to figure out if you want to. And if you can't figure it out yourself, you're asking questions and you know how to ask good questions. So again, when someone tells you it's too complicated, don't worry about it, I got it covered. Beware. Ken.
One of the lessons I learned on this one was about 1998, 1999, I'm in the locker room at Notre Dame with an engineering prof, and he says, I find it interesting that Enron's on campus, they're not talking to the engineers, they're talking to the MBAs.
Right.
And I listened to that and kind of went, and then about 3 years later, it was like, uh-huh.
Exactly. Well, who needs engineers when you're just moving money? Right? That's right. I mean, now to kind of turn to kind of my lessons of kind of root causes. You know, when I show up in the end, like the company's failed and there I am helping a company with insolvency, how did it happen? It tends to be that they end up taking, you know, over time, taking some outside bet. I mean, so some outsized bets where they say, I think this sector of assets is going to perform very well, and they get their balance sheet out of balance on the asset side, and they take big losses in areas that say an insurance company traditionally shouldn't be, you know, turn it around to the financial crisis, all of the collateralized debt obligations, that sort of stuff. And it ends up being that once you've lost the first time, people often have to double down to say, I need to get back to where I was. And it tends to create a spiral with more and more risk. Asset and liability mismatches. And you think about when a number, you know, most recently with, you know, MF Global and other trading enterprises, they were betting on being able to get short-term money to lever up longer-term instruments that they're owning. And they said, as long as you have liquidity that's sufficient for downturns in the market, that model can work. But if you don't have liquidity, as asset values might fall and they ask for more collateral, you can end up with a problem. And my reason I put this here to think about is as you're asked to model something, doing a valuation, to be able to stress test things on the downside, particularly when you are some years into an upcycle. People tend to forget recessions happen, markets drop like we showed. So in terms of when you're asked to do things, think about the downside and to be able to really test and flex valuation models. Back to large intercompany transactions, again, you got to understand them, why. You know, there are legitimate ones out there, lots and lots of them, but when they dramatically change the way the financial statements look, to beware. Transactions designed to window dress or manipulate risk ratings. I didn't say in the guaranteed security situation, the reason he was able to have all these junk bonds and private equity investments in insurance companies that should basically be holding long-term bonds and treasuries was, well, with the help of Merrill Lynch, at the end of each quarter and year end, he did a wash sale to put treasuries on the balance sheet and take the junk off. And they only measured at the end of the quarter. And I mean, I learned in tax class with Professor Milani back here, wash sales have got special tax rules. And the audit work papers had a schedule in them each year that said wash sales. And on that schedule were over 60% of the assets on the balance sheet. I'm like, well, that doesn't look so good when I finally saw them. And that's why Cooper's ended up paying a lot of money for the guarantee, you know, security. But you know, things that designed to window dress, I'm going to play with a regulatory rating or ratio. Be careful. High growth, often through acquisitions, just a riskier place to be because not only might someone be playing with the transaction, you may be acquiring additional risks. And then also the other risk to ethical behavior is in terms of the merging of cultures. Oftentimes I find that's a time when people behave badly for turf reasons and the like. Compensation-driven cultures. I mean, my own belief is compensation is an output of good business. When people talk to you first and early on about the compensation and the money's great, it always has me concerned. If you make good money, the people who are taking the risk of the capital and the people who are doing the work to make good money will get paid well. But when they talk about the bonus pool, the year-to-year bonus pool, and that's the first thing people talk about at company gatherings, tends to be a risky place. Earnings-driven, tone from the top. I mean, where if you get some bad news and you might need to change, make an adjustment to say, I need to put up more reserves, I need to take a hit to earnings this quarter, and you are afraid of how your boss is going to react, and that might cause you not to make that entry or may change an assumption in your models, you don't have to. That happens in these kind of cultures. Supposedly cutting-edge strategy and product, I talked about that. Home office far from the regulator. In the insurance world, it's state by state regulated, but you can have your home office in some other state and be domiciled for regulatory purposes in the state. And of the 30-plus insurance insolvencies I worked on, a high proportion had their home office away from the regulator, so it was harder and more expensive for the regulator to stop by to come and do an examination of the company. And, and they wouldn't be part of the local insurance community, so I've just noticed as a strange thing. Then the board of directors not properly engaged. You look back at a lot of these where I think the name for the Enron board that came out during the investigation was the Nod Squad. You know, there's never a thing that they seem to question or say no to. So for a board's there for a reason. I mean, they're there to look and say, these are risky things, or that doesn't sound right. Or, I mean, Enron gave approval for their CFO to be in charge of these special purpose entities. I don't know why you would do that as a board of directors. And then this is just kind of a subset in terms of kind of fraudulent type of people. Very concentrated on compensation and personal wealth. I mean, again, those are people that are riskier than the average bear. Troubles in their personal life, a sequence of divorces, substance abuse problems tend to cause people to take more risk. I mean, if someone has been divorced multiple times, they've got multiple people they're paying money to, and they want to keep their lifestyle just as it always has been. I mean, I've just seen enough investigations where their personal life has moved over into their professional life. Domineering personality and need to win always. That goes back to Michael Milken. I mean, as I said, in my view, 99+% of what he did, he created a market that's very vibrant today and important, but he got in trouble where he took that last $15,000 of value off these warrants that should have been for the client company and took them for himself. Other small things where it's that need to win, that you're at the table and, hey, a good deal was struck, but then those last pieces are taken off the table, tends to tell you, someone that may cross that line and kind of create risk for you. And with that, that's kind of what I had prepared. So, over questions, comments, discussion?
Questions? So this is all very clear in retrospect. What about when you're a young person, newly been a graduate from Notre Dame? How do you muster the courage to raise your hand?
I mean, you've got to study, when you see something, say, I don't understand this. Well, to me, it's an ethical question whether you say, okay, nod your head and make believe you understand. So you got to work to understand. If you can't figure out yourself, hopefully you're in an organization where you're surrounded by smart people you can ask the question to. So first of all, say, do I think this is empirically right or wrong, the inputs? And then, okay, how are the judgments around it? But then you've got to be confident enough in yourself that, okay, if I leave this job, okay, if I raise my hand and I lose this job, I can get a new job. I never felt at any point when I was at Anderson, if I raised an audit adjustment, I mean, my second year out of school, I'm auditing the judge's retirement system in Springfield, Illinois. Very exciting, I'll tell you. But you had to painfully go through and basically check the regulations in the state code of, well, what basically regulates this plan. There's this question about no one who's been convicted of a felony can receive benefits. I read the papers and say, well, there's been 7 judges in Chicago that were convicted of felonies. So you walk in and say, well, your books have been wrong for a couple of years. And, I think the guy wanted to kill me, but, that was sort of what you have to do. You find it, you got to report it. But it goes back to that my point of, if you think you're well above market in what you're earning, never upsize your life anywhere near what your paycheck is. Always keep it at the level where your replacement job might be, then you don't feel beholden to be there. And you're less likely to be bullied.
Are the social network companies now kind of looking like they could be the next poster child for this thing? Facebook, et cetera?
But, anytime the valuation is so out of sync with the cash flow, you're making a bet on, okay, well, I mean, is this technology going to last? I mean, to take it back to in 1986, I was auditing Ameritech Mobile, and we had a test phone that was like, bigger than my shoe. I'm walking around going, okay, this thing's losing money like no tomorrow. We're building this network. No one can afford the phones. How's this all going to work? It seemed crazy, but the financial statement is fairly reflected. They didn't have a valuation of $50 billion. Okay, so you're in this situation where you're saying, okay, well, Groupon, good example. Okay, well, they come out and they have whatever going on, but then they've already had a couple of hiccups. So it smells a lot like Internet Bubble 1, given the sheer level of values. So if you're in there, and again, you're saying, okay, well, you're in charge of some level of the valuation modeling of businesses they acquired. Is it impaired, not impaired? If you're tasked with interacting with analysts, again, kind of a risky place to be. Or you're tasked with following. You're in the investment bank, and you're the analyst who's got to follow Facebook, pick whoever it is. I mean, it's tough when the cash flow is so far behind the valuation.
All right, well, with that, please join me in thanking Tim Hart.
Thank you.
Thank you.
Thanks for having me.